right, team. Well, welcome to our first Saturday school of 2022. The reality is this actually may be our first and only Saturday school of 2022. But really excited today. First off, obviously I'm not Christian. Christian has a family commitment this weekend, and so he asked me to host. And we'll probably do a little bit more of this in the future, where he and I go back and forth with regards to who hosts Saturday school or our program on a monthly basis. But yeah, today we're lucky and fortunate to have Bryce Gill. Bryce was actually on last year as well and did a similar presentation for 2021 Economic Outlook, right? So I think we're probably going to make this an annual thing. You see he looks a little bit different now. He has a power stash. We're going to have to update his picture for next time. But yeah, super fortunate to have Bryce. We're going to hand the baton over to him here in a little bit. But I did want to give a quick early in the year update with regards to a few things and handle some housekeeping things. So let me go through a couple quick updates for you all before we jump into the presentation. So I think you've heard a lot of this. I do want to go through the normal disclaimer. I'm not an attorney, not a licensed investment advisor, not an accountant, and the information provided today is purely for educational purposes only. People are obviously very familiar with, kind of Redeem Investments. We really have two food groups that we focus on: our investment fund model around commercial real estate, but as well as the renewable energy sector, where we have a renewable energy fund, right? And so there is a residential piece to our business, but that's not our core focus. Now, and the mastermind itself sits, alongside Redeem Investments as a joint venture partner. And so we'll talk through that a little bit more here in a second. What is a mastermind? It's really a JV partnership program. It's ideal for those aspiring to want to become a GP or sponsor in the future. You get access, you get resources, training, meetings, and events, right? And so these resources, one of the main themes that we're going to be talking about a lot in 2022 is leveling the playing field. So we've had some great success stories coming out of 2021 where people that were part of the mastermind early on are now doing their own deals, syndicating their own deals, doing house hacks. So they've used the mastermind to really get them up to speed and accelerate their trajectory around their journey in real estate. And so we're hoping to help do that with more folks. Who are our members? We've talked about this. Go ahead and build all this out. Lots of Service Academy graduates, people that have been dabbling in real estate on the side, but then are now doing real estate full time. I'm one example of that. I left my corporate W-2 job back in April of 2021, joined Redeem Investments full time, and it's been amazing to see the growth and trajectory that we've had as a company and firm, over the last 9 to 12 months, based off of me joining, Christian leaving his job, and us just building the team out over the last 9 to 12 months. So we look forward to what's going to happen in 2022. How can you participate? Just go to redeeminvestments.com. Here's some other aliases and resources for you. Once again, it's a JV partnership program, ideal for those aspiring to be a GP or sponsor. It's not really for the average person that just purely wants to be a passive investor or only seeking to be an LP. Right. This is really for people that are looking to become active investors over time. And we do have LP positions available in upcoming deals and in funds, that could work for those looking for a more passive investment. Right. So we're limiting it to 50 members just to be able to make sure everybody has the resources available and we don't overdo it ourselves with regards to spreading ourselves too thin. So I want to spend a little bit more time here with regards to what 2022 is going to look like. And I'll spend more time on the first half of 2022 because we effectively have something going on every month all the way through the end of the year, right? And so obviously today we're going to be doing the economic outlook for the year. There's going to be a large multifamily conference in Denver and I think most people know this. I'm based out of Denver. And so in conjunction with that best ever conference in Denver at the Gaylord Rockies, we'll be hosting a meetup, right? And so informal, social hour, happy hour, meet and greet. And so even if you aren't going to the best ever conference, it's still an opportunity to spend some time with your fellow mastermind members. And so more information on that. I will have, our virtual assistants send more information out on the best ever conference as well, because, we know the organizers well. They're good friends of mine. And so they've given us a pretty steep discount code that will get, I think 40% off the normal registration fee. So that'll save you a ton of money in the event that you want to go to the best ever conference. And like I said, in keeping with the theme of leveling the playing field, we just want to make sure, that everyone has some fundamental topics, really have a strong suit, and a strong grasp of fundamental topics around capital raising, arbitrage, underwriting, the BRRRR strategy, tax strategies, right? So you can see here on the screen, like what we're planning on going through. There might be some flexibility to this with regards to if, there's some topics that you really want to hit on. I will highlight the June meetup. Like I said, we try to do something in person once a quarter. That June meetup is actually going to be in Cancun. So Christian is a part of a vacation club, and so effectively he has the ability to extend some of the benefits of being part of that vacation club. And so there's really 2 5-star resorts that are right next to one another. One is the Generations, the other one is El Dorado Royale. One's family friendly. The Generations resort is family friendly. These are all inclusive resorts. I was just actually on Expedia just looking at how much a night the Generations was, and I was seeing anywhere from $500 to $800 a night. Last year we were able to go to Cancun in July as a mastermind group, and I think it was right around $200 a night, all inclusive. And so that includes meals, and that even included, I think, 4 bottles of alcohol that you were able to take a handful back here to the US after the week-long trip. So more information to follow on that. We've already have, I think, like a 2025 block room block available. And so we'll send more information out on that. But yeah, some great topics for the rest of 2022. I'm not going to talk to this too much. I mean, obviously, if you make money, you want to be able to keep it, capital preservation. But once you keep that money, you want to make sure you multiply that money, right? And so that's the wealth formula. This is funny. Bottom line up front, that's what Bluff is for those that don't have military ties. We do think commercial multifamily is where it's at. Been talking to a ton of institutional investors, just folks that are smart in the real estate world, and Sunbelt multifamily, has very strong advocacy within the real estate community. And so where we've been, and we'll talk about this more when we have our monthly accountability group session, but not going to dive into it too deeply here. Where we've been, right? We purchased a 44 unit asset in Arlington, in the Arlington Entertainment District, for $3.8 million back in 2019, added about $1 million in upgrades and capital improvements to it, raised rents and charges to a significant amount, created a whole bunch of equity, and we're in the process of refining that 44 unit asset for just under $8 million, right? In just about 2 years time frame. So that's where we've been. We're about to close on an office mixed use conversion project that we're looking at in Temple, Texas. For those that aren't familiar with Temple, it's in Central Texas, kind of in the Killeen, Belton, Temple MSA. There's just shy of, I think, 500,000 people in that submarket or in that MSA. And so, we're buying, prime office space right in downtown Temple, in the heart of where a whole bunch of redevelopment's happening. And this deal is going to close potentially, I'd say right around the February 23rd timeframe. So more to follow on that as well, as part of the monthly accountability group session when we get that scheduled. And this is where we're going. We have under LOI a $29 million property in Las Colinas, which is basically a submarket of Irving, Texas. I mean, the Cowboys, before they moved to Frisco to practice, had their practice facility in Las Colinas. And I mean, this is a very, very affluent part of DFW. And DFW is DFW has been for a while now the top multifamily market in the nation, as far as volume. And so, here we are able to get an asset. We preemptively got this under LOI before it actually went to market through our broker relationships. And so, yeah, we're excited to share this opportunity with you all and see how the mastermind wants to get involved. So, I mean, I'm not going to talk through all of this. I mean, obviously, we're excited about providing tax advantages, forced appreciation, and helping people grow wealth, right? And so that's the spiel. Would like people to join us for that monthly accountability group session once we get it scheduled. But at this point, super excited to introduce Bryce, have him tell him about himself, and then go into his content for our session. So thanks for listening.
Yeah, well, hey, everybody. My name's Bryce Gill. I'm an economist with a company called First Trust Portfolios. We're a Texas-based company now. We originally started out in the Chicago suburbs. We've got 2 major offices. We specialize in things like ETFs and unit investment trusts. We've got about $250 billion under management. Chances are, if you've got a retirement account and a financial advisor, you probably own some of our products. So I'm one of the Austin, Texas-based economists. I've been down here for about 5-6 years now. I love it. So, I'm local, and it gives me a chance to, really experience the growth that we've seen in the Sun Belt firsthand. And that's kind of what I'll get into today. Just talk about where we're at with the economic recovery, some reasons why, the Sun Belt is outperforming here. And also we'll talk about inflation and the housing market specifically. It's really interesting because when I joined last year and we did this kind of Saturday school in January, the rate of inflation was about 2-3%, right? It was before this kind of impulse that we predicted had happened. And so, back then I was talking about, hey, buy commodities, buy real assets like residential real estate. Inflation is going to kind of come roaring back here. And, here we are a year later and inflation's at a 40-year high. And so we'll get into some of the reasons why that is and, why, I remain kind of bullish on real assets going forward. It's a really interesting story with the pandemic. I think in a lot of ways it's massively accelerated, people's movements down to the Sun Belt region. And so we'll kind of get into that. We'll talk about the recovery. We'll talk about, where people are moving to and inflation and kind of close on the housing market. So with that, guys, I'll kind of share some slides and we'll get into it here. So Michael, can you see this okay?
We can. Yep. We can see your slides.
Okay.
And for the folks on, definitely want to mention that obviously if there's questions that come up during the presentation, feel free to throw them in the chat or under Q&A. And depending on where we're at in the presentation, I may interrupt Bryce, but otherwise we'll certainly get to your questions as we go through the presentation.
Absolutely. Yeah. So guys, I'll kind of start, broad here and we'll kind of drill down to what's going on over time. And where I really want to start out is, hey, where are we at in this labor market recovery? Okay. Or really the economic recovery in general. And what I have is total employment in the US on the screen here. And you can see that massive collapse early on. We lose like 24 million jobs in 2 months. By the way, that's like 3 times the job losses as 08, 09, right? I mean, this is a complete collapse in the labor market at the time. But, on the flip side, even though the decline in the labor market was really rapid, the recovery has been as well. We've gained back about, 85% of the jobs, 90% of the jobs we lost. We're forecasting we kind of get back to that, 2019 level of employment by, mid to end of this year. And, most people call this pandemic, the economic impacts of it a recession, right? That we've been kind of characterizing it that way in the media and everything else. And I almost think that this is the wrong way to think about things. This really wasn't kind of a recession in the traditional sense, right? Where we, 08, 09 is the classic example where we overbuild or overinvest in one sector, that being housing at the time. The bubble kind of pops, there's this financial crisis, and then we got to reallocate resources to all new sectors of the economy. And that's just a protracted kind of situation, right? It takes a long time. And so, this time around, though, we headed into this pandemic with a pretty strong economy, like fundamentally very strong economy. And so, I think thinking about it in terms of a recession is actually the wrong way to look at things. I think what we had was a suppression, okay? And that's just based on all the different public health measures and things like that related to COVID. And so, this has been a relatively fast recovery, much faster than most recessions. And that's not surprising to me at all because, we didn't really have a recession in the traditional sense. We had a suppression. And so once we remove these kind of government policies around public health, things kind of come roaring back. And so I think that's important to keep in mind. I think, it's one reason why we've bounced back so quickly, especially down here in Texas, for example. And so, that being said, if we look at the overall average numbers in the United States, I think we miss a huge part of the picture, right? That slide before was just the average numbers. And to kind of show you this and kind of the breakdowns by region and how much certain states have outperformed others, what I have here is data from OpenTable. Okay, so this is the restaurant reservation app I think most people are familiar with. And the reason I love this data for the pandemic, it's probably my single favorite series so far during the pandemic to look at, is that, hey, not only does it cover the hardest hit sector of the economy during the pandemic, which is restaurants and bars, right? I mean, they've gotten hit worse than anybody else. But, it also comes out daily. So we have a really high frequency look at how things are doing. And so that black line at 0 there, that's the baseline of where we were on the same day of the year in 2019. So that's before the pandemic. So, if the line kind of hits or exceeds that black line, I would call, that area of the country fully recovered, right? And I've got the U.S. average there in blue, and you can see we've kind of hit the black line a couple of times, and it can't quite stay above it as the U.S. as a whole. But the big story to me is looking at different regions, like I mentioned. And so, in that vein, I've got Texas and New York on the screen here, Texas in orange, New York in gray. And the reason why I've done this is because, hey, these are clearly on polar opposite sides of their pandemic reaction, right? Not just from an actual government policy, lockdown perspective, but also just from a cultural perspective, how risk averse people are with regards to the pandemic, right? And so, Texas is a great example to look at because, hey, as of February of 2021, that orange line has been above the black line. Texas, the restaurant industry, the kind of leisure and hospitality industry has been fully recovered for about a year now. But when you really go and compare and contrast that with places like New York, I mean, the differences there are extremely stark, right? In New York, that gray line has basically been stuck at minus 40% from 2019 levels of activity at restaurants and bars for, since May of last year, okay, and hasn't gone anywhere. And so I look at this, and what it tells me is there's pretty permanent scarring in the New York service economy, right? And a lot of this comes down to New York City and Manhattan, okay? And, part of this is, people are still afraid of the pandemic there. Part of it is, restaurants and bars and businesses just closed and decided to open up shop elsewhere. Speaking from personal experience here in Austin, we've got all kinds of chefs from New York that came down here because, hey, they don't want to deal with the kind of schizophrenic regulations that are happening on a semi-regular basis, right? So they just picked up and moved shop. But I also think it's a big part of the story is the work from home situation that we've seen, right? The big superstar cities are the huge losers here because for 40 years, people have been moving to the cities for, the kind of network effects, right? You have to be around other people and that's where all the jobs are. And so you tolerate the high rents because, hey, that's where the best kind of employment is. Well, now all of a sudden, nobody's going in the Manhattan high-rise buildings. No one's getting drinks after work. No one's going to the Broadway shows anymore. And, it looks to me like New York, which was a cultural capital of the country, has really seen its nightlife sector have some permanent damage here. I think it's going to be a really protracted recovery. And so, the losers here, in my opinion, are, Illinois, New York, California, and the big winners have been, obviously some of the Sun Belt states, right, that have been better on these policies. And so, a huge divergence in outcomes that I think is completely hidden by when we just go and we look at the overall average numbers for the United States. So something to keep in mind there. And, reason to be kind of optimistic about the southern states, right? Kind of another just example here is just unemployment rates to show you guys, hey, there's a divergent recovery going on in the U.S. right now, right? And so I've got the U.S. average there in orange. And again, what we see is, hey, California, New Jersey, New York, they have much higher unemployment rates than like Florida, Texas, Georgia, Indiana, right? And so I don't think this is going to shock anybody to see this, but the data confirms that, hey, the states that have been open longer and kind of trying to get back to normal since really the summer of 2020, well, they've seen their labor markets outperform. Okay. And so, that means, hey, more personal income, more spending, more, economic activity happening in those places. Now, I really think the big story from a real estate perspective and kind of in the context of what we're talking about today has been the internal migration going on, right? And, last year when I did this Saturday school, I was telling you, I told you guys, hey, listen, I know this is going on behind the scenes, but I just didn't have any solid numbers to back it up yet, right? A lot of it was just, anecdotal or looking at like U-Haul truck data or whatever. And so, now we have hard numbers from the U.S. Census Bureau on this. And, it's pretty interesting to see that, there's been a big shift again towards the Sun Belt states and away from the superstar cities is how I kind of characterize it. Okay. And so this is the change in population from April 1st of 2020. So, 3 months into the pandemic or, 2 months into the pandemic through July of last year. So it captures a huge part of the overall pandemic so far. And again, what we see is, Texas has been the number one recipient state in the country. Texas has gained, almost 400,000 people. Florida, Arizona, North Carolina, Georgia, also big winners here. And those states on average have added about 1% to their population from just internal migration during the pandemic period. And then, conversely, obviously, is, New York, California, Illinois are losing people very rapidly. So again, I look at those are the superstar city states, right? Chicago, New York City, and like San Francisco and LA. Well, they've been losing people like crazy. And, obviously, again, work from home is a big part of this. But I think, we're finally seeing Americans voting with their feet and like kind of federalism at work. And we're seeing a big decentralization of economic activity away from the superstar cities. And so they've really dominated economic outcomes for 4 decades in the United States. Everybody's been moving to them. Well, I think we're seeing decentralization occurring here in the U.S., kind of like we haven't seen in a long time. And, this is a boon for mid-sized cities across the country, right? And suburbs. And so places like Tampa, Florida, or Nashville, or Austin, Texas, or Raleigh, North Carolina are all doing very well. And it's these big, massive cities that are having trouble, keeping people. And I think a big part of it is, they're all on the COVID roller coaster, right? Every 3 months they lock back down or institute new pandemic related measures, and people are kind of over this. And so people are moving like never before to the southern states. And obviously, guys, people are moving down here. They're going to need places to live, right? And so I think this is one of the biggest reasons to look regionally in the United States and note that, hey, there's a lot of investment opportunities in residential real estate kind of across the board in the Sun Belt. And, certain places in the country are losing population pretty rapidly here. So again, kind of divergent outcomes, but also a reason, to notice that, certain places, there's a lot of opportunities, especially with, and that's not just residential real estate, right? It's like amenities and everything else. I think the mid-sized cities in the country are going to be driving economic growth. Whereas, hey, in the past, it's just been New York, San Francisco, and Chicago that have been doing that in a big way. And so with that, guys, I want to shift focus here. We'll talk a little bit about what's going on with inflation. And, when we talk about it on the news, or we see most of the coverage, most of what we talk about in the United States is supply chain issues, right? That's the big scapegoat. And I think this misses a huge part of the story. And really, looking at the supply chain problems, I almost look at those more of a symptom of the actual cause of the problem with inflation, which is, a massive surge in demand in the United States. Okay. And so to illustrate this, what I've got is US personal income in blue. And then I've created a long-term trend line for US personal income. So that's just, hey, if we grew at like the historical average every year, there was no recessions, there's no massive government stimulus, where would personal income be? So we have a basis of comparison. After 0809, well, hey, personal income's below that orange line for 10 years, right? And that makes sense. That's every recession that we've ever had where personal income falls because people become unemployed, right? And that's why we couldn't hit our 2% Fed target. That's why we're talking about secular stagnation and a slow recovery. But 2020, 2021, I mean, wow, it could not have been a more different situation in the United States because we had 3 times the job losses in 0809, but personal income in the United States never fell. It surged multiple times. And you can see the spikes individually in the line here. And that's all the government stimulus programs, right? And so collectively in the past 20 or so months, we've spent about $5 trillion on COVID stimulus in the US. And that's about what we spent on all of World War II in inflation adjusted terms, okay, to put things in context here. So this is a massive fiscal impulse. And hey, World War II, we spent a lot of money, but we also produced a lot of productive capacity, right? We're building factories all over the country that could then, hey, the war ends, we can convert, the bomb making factory to making refrigerators or whatever else, right? And so, the productive capacity of the U.S. massively increased along with, that fiscal impulse. Well, hey, this time around, we basically spent money on sending checks to individuals, right? Productive capacity didn't rise at all. If anything, it got massively hurt by all the lockdowns and capacity restrictions and things like that. But demand has just absolutely boomed, right? And so, where that blue line ends there is November of 2021. And so, it's really interesting to me that that's still way above the long-term trend line because that's after the boosted unemployment benefits ended. That's after the stimulus checks have ended. PPP loans are over. And we're still, 3 to 5 million jobs short of pre-pandemic levels. And personal income is still way above the long-term trend line. And so from a demand perspective, U.S. consumers are in an extremely strong position right now. But obviously when demand runs, consistently ahead of supply, like we've seen during this pandemic, well, hey, the result is going to be inflation, right? And so I think that's where a lot of this is coming from. Keep in mind, guys, that the M2 money supply is up something like 40% from pre-pandemic, right? That's the high power money that gets used in economic transactions. And I almost think of it like, I think when I was a kid and I was watching Looney Tunes and like a snake would eat a cow and you would see like the entire outline of the cow in the snake's body. That's like the US economy right now. There's this huge chunk of money and it's just trying to slowly digest it over time. And that's just going to take a while to happen. And so, typically monetary policy, things like this, takes 18 to 24 months to slowly make its way into prices. And so, how long is this inflation going to last? I don't see any way we get back to the Fed's 2% target anytime over the next couple of years. I think just based on the money supply, increasing so rapidly. And the other side of things here is housing. I think is a huge part of the story with inflation and a reason to expect, hey, inflation remains, above the Fed's target, significantly. Okay. And that's because housing, they call it shelter, right? But it's the largest single component in the consumer price index. It makes up about a third of the overall index. And, it's interesting because housing prices across the United States, if we look at them, they're up 20% plus, right? I think most people know that, especially, hey, if you're investing in multifamily real estate. So the cost of residential real estate has been booming. But if you look at how CPI measures it, they're just looking at rents. Okay. And so, rents have been depressed. And by the way, as we sit here today, rents are only up like 4.5% year over year, even though housing costs are up 20+%. And the reason is kind of there's kind of a twofold reason here. Okay. One is the rental eviction moratorium across the country, which is now over. But that had been holding down rents because obviously, hey, you can't evict non-paying tenants, and that impacts the overall numbers. But also, people had been moving out of the cities where rent is the most expensive and back into the suburbs where rent is more cheap during the pandemic, or hey, just living at home with their parents and not paying rent at all. And so there was a kind of a couple of reasons why these two series diverge. Well, here we are today. Most places across the country are reopening. People are moving back to urban areas. Even if it's not New York, people are moving to Tampa, or they're moving to, Phoenix, Arizona, or wherever else it is. And hey, the rental eviction moratorium has ended, right? And so this housing component of CPI has begun to rise very rapidly. And so, if we can expect rental costs to rise anywhere near the rate of, housing costs in general, even half as fast, well, a third of the CPI index is going to be rising at, double-digit rates, right? And this is going to put a huge floor underneath the overall inflation readings. And so, kind of one reason right there to expect, hey, we're going to stay above that 2% Fed target kind of for the foreseeable future. I don't see any way in the numbers that all of a sudden, we get back to 2%. So I think we're going to be in the, 6% range by the end of the year if we're lucky. And, that's, hey, if nothing else happens, right? No other shocks from abroad, or, China doesn't invade Taiwan or anything else. But, this is a 40-year high in inflation. And it seems to me when I listen to the arguments about why this will be short-lived, they're the exact same that they were, a year ago before the inflation surge even occurred, right? People are saying it's all going to be temporary and it'll work itself out. Well, I think there's reasons to be, possibly less sanguine about that, right? And it's also important to note, hey, guys, the inflation numbers haven't even peaked yet, right? I mean, they keep accelerating. We just went from like 6.5% to 7% year over year on Wednesday when we got CPI. And so there's no evidence in the data, from my opinion, yet that price increases are slowing down, let alone falling back to like that 2% Fed target. And so, again, what does best under kind of an inflationary environment is real assets, right? So things like commodities, things like real estate. When we look at like the equity markets, for example, it's value, it's dividend payers, it's size and quality that tend to do well there. And I would stay away from things like government treasuries and other financial assets that really don't have any claim on real assets at all. So here's another reason to really expect inflation to continue. And by the way, I think there's another reason to expect rents will continue to increase, and that's that wages have been surging like never before in the United States. Okay, and to kind of illustrate this, what I have here is average hourly earnings, and this is for leisure and hospitality. Okay, so this is like restaurant and bar employees. I'm just using them as a kind of example here, and it's the percent change year over year. And so, this goes back to 1965, and the reason I think that's interesting is because it captures that whole inflationary period during the 1970s that has been at the forefront of everybody's mind recently, right? And a big part of the story back then was a wage price spiral, right? People's wages are rising rapidly. They're spending money that feeds back into prices, which, then feeds again back into wage increases. And so, in the 70s, what we were seeing is, hey, we peaked early on in like the late 60s at about 12% increase in wages, really more around like the 10%, 11% through that inflationary period. Well, here we are. And then from like 85 to 2 years ago, 2% a year increase in wages was the norm, right? Well, here we are in, the COVID era, or coming out of this pandemic, and wages in leisure and hospitality are up about 16% year over year. They're rising the fastest on record that the U.S. government has ever seen, okay? Or at least, that this data series has ever seen. And so, it looks to me like this is a reason to expect, hey, landlords can probably raise rent. People can afford it. And by the way, this is probably a reason why inflation stays relatively high. Wages are rising rapidly for people that, spend a large portion of their paycheck, right? And so wages are another reason to kind of be concerned here, but also a reason to look at things like real estate as a positive investment. You're looking at the people that are going to be paying rent and their wages are surging something like 16% year over year. Well, hey, all of a sudden, a 10% increase in rent or something like that is nothing like what it was in 2000 when wage gains were 2% a year, right? So another reason to kind of expect residential real estate to continue to perform well here is just that, consumers and renters are going to be able to absorb larger rent increases. And, a big reason to kind of think that inflation is these pressures aren't going to disappear anytime soon, especially with wages rising so rapidly. And, again, rent making up such a large part of the overall CPI index. So I'll kind of finish off here, guys, with a reason why I'm personally very optimistic about residential real estate in the United States. And that just comes down to something pretty boring that really doesn't get a lot of coverage, and that's demographics, right? I mean, the news loves to talk about like the new big spending bill in Congress or, anything else like that kind of captures headlines. But, longer term demographics are probably the best thing that we have to predict outcomes in the real economy. And so, in that vein, what I have here is the US population of everyone ages 30 to 54. Okay. And the reason why I'm looking at this demographic is because, this is the big spending demographic. If you look at history, right? These are the people that are buying houses and cars and washing machines. It's the big spending years of everyone's life. And so, I think it's really interesting because the total population of people in this age bracket from about 2000 to 2020 was flat. It didn't go anywhere, right? There was no net gain in the number of these people at all. And that's because, hey, the millennials were too young. And at the same time, the baby boomers were kind of aging out of this age bracket. And so we saw basically no net growth in this demographic at all. And I think this is a big reason why not only, hey, we saw the housing market blow up in 08, 09, prices are rising massively and demand for housing really isn't, as from a demographic perspective. But also why economic growth has been relatively slow, right? We've been growing about like 2% real GDP growth. And that's because, hey, the big spending demographic has been flat. But, as of 2020, 2021, and this is all data from the US Census Bureau, well, this population is starting to explode and is going to, increase by about 25% by 2060. So it looks to me like huge secular tailwinds, not only for economic growth, but especially for things like residential real estate and autos, right? And hey, the used car market is going insane. What's going on there? Well, hey, maybe demographics are playing part of the role there too. It's not just semiconductors, right? And so, there's a big reason why I'm pretty optimistic on real estate going forward. And, one of my big sector calls has been the home builders in general, is that we just have a huge shortage of real estate at the same time that demand is now going to be surging over the next several decades, right? And recently we've begun to see it happen. The millennials today are now the largest living generation in the country. They outnumber the baby boomers. And as of 2019, they made up over half of mortgages in the United States for the first time. And so, again, a huge source of ongoing demand for housing and also other big ticket purchases in the United States going forward. And I think demographics are maybe the strongest reason to continue to be exposed to residential real estate. And I think we're basically at the beginning of a secular boom in housing in the United States. That, guys, I'll kind of close out here. Obviously this isn't a presentation for First Trust, but hey, if anything I've said is interesting to you guys, I want to say, all of our content is available to the public for free. I've got 2 examples of kind of what we write. We call it the Monday Morning Outlook, but we also publish pieces on every major piece of economic data. So, say you're really interested in the consumer price index, we're going to have that out every month. And everything we write is 1 page. It's easy to read, easy to share. It's all approved for use with the public by compliance. So you don't got to worry about any of that. And if you'd like to receive any of this stuff, guys, all you have to do is just Google First Trust, subscribe, and put your email in. You don't have to be a client. All this stuff is available for free. You can also just follow me on LinkedIn as well if you don't want all this stuff showing up in your inbox. I repost everything that we write there, and that's a great way to stay exposed to the research as well. And so with that, I'll go ahead and turn it back over. And if we have any questions, I'm happy to take those.
Hey, Bryce, thanks for that. That was fantastic. I mean, really great information there. I mean, as multifamily investors, I think we have to be absolutely excited with, the report that he just gave. I mean, I think it's funny, going back to 2016, 2017, I'm sure people were saying, oh, there's no way that multifamily is going to keep going up or real estate is going to keep going up. I mean, we're bound for a recession, right? So, I mean, from a driver perspective, I mean, things are continuing to show just the strength of the asset class. And so, I mean, I guess with that, Bryce, one thing I want to ask is, and we didn't really talk about it, but, is the government or the Fed going to do anything, perhaps maybe to slow some of this stuff down with regards to interest rates or, I mean, the main question there is like interest rates. We didn't really talk about that.
So, the Fed's saying they're going to hike interest rates 3 times, 25 basis points each. So, at the end of the day, we're talking 75 basis points. And obviously, hey, if mortgage rates rise from like 3.25 to 4 or 4.25, that increases the cost to own a home. And I understand that. But also at the same time, demand is so high in the United States that 85% of housing, sells within a month of being listed. Okay. And so I look at it and say, hey, people's wages are rising extremely rapidly. Millennials are aging in the housing market. They want to own homes now. They're a little delayed from like student loans and that other stuff. But I don't see 75 basis points in hikes from the Fed killing the housing market here. And really, that huge tailwind of demand that I was talking about, even if we have it, let's say we get into 2023 and 2024 and the Fed keeps raising rates and, maybe that chokes off some demand for housing. Well, I really think this is a longer term story than just this tightening cycle by the Federal Reserve. And so, I would say that, hey, there's probably going to be volatility in housing as we get kind of further into the hiking cycle. But at least for 2022, I just don't see them moving enough to really have a massive impact on the real economy, right? I think there's going to be a ton of volatility in financial markets. And we've definitely seen that recently, especially with high growth and PE ratio tech and growth names, the NASDAQ index and stuff like that. But I think, as far as the real economy, people buying homes, people buying cars, 2022, 3 basis points in hikes is, 3 25 basis point hikes is not going to be enough to derail, the progress that's being made.
Okay. Well, thanks for that, Bryce. Let's look at some of the questions here that was provided in the chat. It looks like we just answered this one. How do you see rate hikes over the coming years affecting real estate? So you just answered that. And then there's another question about, does the uptick of wages and rising rental prices stall the recovery?
Yeah. So, I mean, let's say, if wages are rising 16% and rental prices go up 10%, let's say, which is, that'd be at the high end of even what I would predict is 10% increases in rental costs on average across the country. Well, hey, you still have a huge chunk of extra cash on top of your increased rental payments anyway to go out and spend and buy other things. And so, if wages keep running so hot, I think it keeps inflation going as well, but I don't see increases in rental costs as necessarily choking things off here. And by the way, keep in mind, a lot of people across the country just had a huge windfall from this rental eviction moratorium, right? Especially the people that would be, the most likely to slow down spending elsewhere after their rental costs actually begin to rise again. And so, yeah, I think if wages are massively outpacing rental increases, that means the rest of the economy and consumer spending elsewhere can continue to grow. And really, I just think we're under a boomflation type situation. I know a lot of people are really concerned about stagflation. Obviously, that's what we saw back in the 1970s. But with wages rising so fast and a lot of job gains left to happen, I really think the constraints here, it's supply. There's not enough things to actually purchase, right? I mean, the shelves are bare in the grocery store. There's not any new cars on the lot. So those are the places that I kind of worry about, is just shortages and lack of supply. I think the demand is there in kind of a way we haven't seen in a long time.
Yeah. Okay. So yeah, keep the questions coming in the chat, or feel free to come off of mute if you're able to either raise your hand or just jump in here with questions. One of the things that we talked about earlier when we were preparing for this session was obviously the benefits of real estate around taxes. And so Bryce, would love for you to kind of weigh in with regards to status of tax reform, how that might change things for real estate, midterm elections, all that.
Yeah, well, I'm not going to postulate on kind of the real estate tax stuff. I think you guys are the experts there. So, guys, ask the great guys at Redeem. They'll be able to give you way better information on that than I can. But I can speak to broader tax reform and what's been happening there. And the bottom line, I guess, is it looks like this Build Back Better bill, which is it was like another several $1 trillion in spending, and then there's like increases in corporate taxes and some other stuff like that. It looks dead to me. I don't see any way that they're passing this. Joe Manchin famously kind of locked things up in the Senate and kind of killed the bill. And so, I almost look at, now we're in this midterm election year. I don't see how they get a bill together before this and kind of iron out their differences. And, with inflation raging, if we look back, by the way, guys, I'm making like a political, I guess, forecast here, right? I'm just kind of going off my intuition here and kind of what history tells me. So, maybe I'm wrong. Maybe the Democrats do really well in the midterms, but, with 40-year high in inflation is one of the most salient political issues there are. It's not, it's nonpartisan. Everyone hates inflation, okay? Especially historically. It was one of the major reasons Ronald Reagan won, and then also got a second term, right? He promised to end it, which Jimmy Carter failed to do. And then, he got reelected after, Paul Volcker, helped end the inflationary impulse, right? So I don't know. I just look at things and say, hey, 40-year high in inflation is in shortages in a lot of different goods and services. This is a terrible thing to go into the midterm elections with for Democrats. And so I think the Republicans are probably going to do well here. That'd be my, I guess, guess here. And if that's the case, well, that means gridlock until 2024, right? There's nothing that's going to get passed if all of a sudden the Republicans control the House and the Senate again. And so, I would not expect any tax increases to happen here. I just don't see the path for it to take place anymore.
Got it. Okay. Well, thanks for weighing in there. Any sort of other questions from the panel attendees? Let me give it one last go. Okay. Well, let me pull up Bryce's information again, right? I mean, obviously he gave you his contact information, but want to make sure you guys have an opportunity to get his email and his phone number again. So that's up on the screen. But yeah, Bryce, thank you so much for helping us kick off 2022. It's January 15th right now, so I think I can still say Happy New Year to everybody on this. And for those that view the recording, like I said, this is early 2022 right now, and had the opportunity for Bryce from First Trust Advisors to join us today and talk us through his economic outlook for 2022. And hopefully, like I said, we make this an annual thing, because he's been such a great resource for us. So yeah, if there's any sort of follow-up questions, thoughts that didn't get brought up here during this session, feel free to reach out to me. My email is michael@redeeminvestments.com. My partner is christian@redeeminvestments.com, but we're always happy to have conversations with regards to the economy, multifamily, and how we can help folks find asymmetric returns. So once again, thanks for joining us today. Enjoy the rest of the weekend. Have a great MLK weekend. We'll talk to you soon. Take care.
everybody. Have a good one.